Sheldon from Crypto Banter is ready to pull the trigger, my friends. Let's get ready for a short squeeze. There are billions in liquidity, all the way up to 99K. And the market is about to go for it. On the other hand, Matthew Sigel, the portfolio manager from VanEck, is pulling the institutional handbrake. Global liquidity is tightening and on-chain activity is negative. His target to buy? Around 78K. Two completely opposite views, but only one, as you well know, will survive. As always, I take the most bullish and bearish takes of the day, and today there were a solid 4 of them. I'll pit them against each other, and in the end, we'll see who's reading the market best. No more random opinions. From today on, we're measuring consistency, data, and results every single day, folks, okay? All right, let's start with the bullish side. And today, Sheldon from Crypto Banter, strangely, comes in with a hyper-tactical view. He sees a perfect technical setup for an explosive short-term move. It's not fundamental analysis, it's pure trading, folks. The bullish signals he cites are technical. First, the liquidation maps. There are tons of yellow, billions of dollars in short positions. Just above the current level, by the way. Sheldon sees the shorters trying to defend the 89K wall. But he predicts the market will go hunt the enormous liquidity parked all the way up to 99K, causing a violent squeeze. Second, the technical breakout and the dominance. Bitcoin has shown signs of life, breaking a short-term trend, marking a higher low on the 4-hour chart. Furthermore, the Bitcoin dominance looks very bearish. And this means that altcoins, like Solana, which he's monitoring, could move very aggressively during this pump. Third, the risk-reward setup. For Sheldon, this is the time to increase risk appetite with tight stop losses. If he's wrong, he loses a little. If he's right, the gain is explosive, guys. The bullish conclusion. Nobody believes in this move. It's the perfect time for a violent pump, a flash up that catches the market by surprise. On the other side, we have Matthew Sigel from VanEck, who brings an institutional perspective, cautious and based on macro data. In his view, the market is sending mixed signals, and institutions, although interested, are hesitant, to deploy capital. Sigel analyzes the market through 3 lenses, and the results are mixed. Global liquidity, yellow, red. Credit conditions are tightening due to huge investments, capex, in AI infrastructure. Bitcoin miners are selling Bitcoin to finance their expensive pivot to AI, creating a vicious cycle. Second, crypto leverage, green. Leverage in the system has been wiped out by recent liquidations. This is the only positive signal. Third, on-chain activity, red. Transactions and addresses are down, negative. His strategy is prudent. He is already de-risked by selling 15% of his positions in miners and is waiting to re-enter. His target is around 78K. This level represents a 40% drop from the peak, which she justifies by noting that Bitcoin's volatility has halved compared to the previous cycle, which dropped 80%. A prudent conclusion. Conflicting signals mean uncertainty. The 77 to 78K level offers a reasonable risk reward to start accumulating slowly, guys. So Sheldon says, an imminent short squeeze towards 99K. It's time to aggressively trade the bounce. Sigel replies, the market is fragile, my boy. Macro liquidity is tightening and miners are selling. Let's wait for 77K for real accumulation. Tactical trading versus institutional patience. 2 completely opposite reads of the exact same price action. Now, let's get to the real data, guys. My analysis. 1. The overhead liquidity identified by Sheldon is real and often acts as a powerful magnet for the price in the short term. I'll give a point to the bulls. 2. The fact that leverage has been wiped out, noted by Sigel as a positive, removes forced selling pressure, favoring a bounce. Another point for the bulls. However, the global credit tightening and miner sales to fund AI are real systemic risks highlighted by Sigel. This is a point for the bears, and the weak on-chain activity confirms the lack of new organic interest, especially in the spot market. Another point for the bears. Here's my summary. The technical setup for a short squeeze in the very short term is plausible, especially with the PPI data coming up, which can create volatility. However, the macro and on-chain concerns suggest that any pump could be short-lived. Even Sheldon calls it a potential fake pump. The real institutional support actually seems to be positioned further down, waiting for the 78K area. Okay? Remember, I'm not rooting for anyone. I compare the data, the flows, and the liquidity. Okay. Always. I'll see you in the next video. Thanks for watching, and see you soon. Bye.